It's time for another edition of the Outstanding Shift podcast with your host, Andrew Evans from Rossby Financial. I'm your producer, RJ Malik. Andrew, hello there. How you doing today?
Great, RJ. As always, correct as usual, King Friday. It's always great to see you.
It is great to see you. So why don't you just jump right into it? Tell us what today's podcast is going to be about and welcome your guest.
Absolutely. Today, it's all about making soufflés. and I think that's what it is. We're talking about something that nobody really ever talks about, but you tiptoe around because you got to tiptoe around a soufflé, don't you? Today we're talking about the wonderful world of the advisors and firms E&O insurance with our good friend Chad Ramberg from Box Insurance. Chad, welcome aboard. Ahoy to you. Thanks for coming on.
Ahoy. Yeah, absolutely. Thank you for having me. I was trying to think of, I grew up with, my dad had a commercial fishing boat. So I was trying to think of what a good response would be to that. And I couldn't come up with anything good.
Yeah. You know, years ago, I don't know what he's doing now. Back in Pittsburgh, where I'm originally from, one of the sports commentators, his name, Ellis Cannon. I don't know what he's doing now, but he would always do a thing when people would call into the show, they would always say to him, like, permission to come aboard. And he would say, permission granted.
There we go.
And then they
I
do
like
the thing.
that.
So maybe we should start doing that. All respect due to Ellis Cannon for me swiping that from him. So if you'd like, please.
Permission to come aboard, sir.
Permission granted, Chad.
All right. Thank you.
Now, Chad, for those that don't know you, but obviously everybody knows you. Everybody knows who you are.
I would think, right?
I mean, at least by now.
Everybody loves insurance. It's the most important thing at a party.
It is. Everybody loves to talk about it. I mean, I can't believe, how many times when I'm talking to somebody in an airport and they want to talk to me about insurance, I'm like,
absolutely.
And I tell them, you talk to the wrong person because I'm ready to talk about it. But Chad, give us your background. Tell us about Box. Give us your background, a nice intro to you, and then I'm going to ask you the outstanding shift, demonstrative, startling question.
Okay, sounds good. Yeah, so you know what? It's kind of funny with talking with clients, and they ask, "Where'd you come from? How did you get here?" I didn't plan to be selling insurance. In fact, I used to say, I do not want to be an insurance broker. Those guys are boneheads. They're just out there collecting premium that I have to pay every single year, and it goes on, and they're not really doing anything.
But they all thank you for paying the premium. Everybody.
Just without a doubt. Without a doubt.
Much.
Rent seeking is the way I think about it. Okay. And there's I suppose there's a place for that. But I used to have a negative view of it. And that was probably because I spent 20 years on the claim side of insurance, which means I was really arguing with adjusters to get them to pay claims. And I saw, some good, the bad, and the ugly of what happens when you don't have good coverage on the front end, how you got to deal with it on the back end. And then I became a claims adjuster for a couple of years for Zurich. Probably a lot of your clients have heard of that company. Mm-hmm. And then when that career ended, I said, I got to do something different. I had a financial acumen. So I said, I'm going to become a financial advisor. And I did. I got my 63, 65, life health, everything you could get to be able to sell it. And I went out there and I hit the streets, and I was a crap insurance. I'm not crap insurance. I was a crap financial advisor. I didn't make it. But the good news is that time that I had, it gave me enough experience to, one, really respect and appreciate what good advisors do for their clients and how hard it is. Most of you make it look so easy, which is really cool. And then I pivoted because I wasn't bringing enough bacon home to eat off of. Mm-hmm. And I started helping advisors with their business insurance. And I learned what I didn't know. Which is almost everything about insurance. And that was 13 years ago. And about 7 years ago, I
6, 7 for the kids at home. 6, 7.
There you go.
Good job,
man.
Good job. We did it. We're
got
relevant.
There.
We did it. All right. Shut down the pod. Shut the pod down.
Right.
We did it. We did it. We're done.
That was clever.
As they say, we're
that
chopped.
Came right in. Is it okay?
The kids say we're chopped.
You're more hip to it than I am. I'll say that. So no, we got in there and I said, you know what? I got my guts together and I said, I think we can do a pretty darn good job. So we went out and I partnered with a 100-year-old insurance brokerage firm in Texas and said, let's start a firm that's specifically for the financial services industry, specifically for RIAs. And so that's what we do. And that's most of our clients. And we got a few broker dealers, a few, private investment fund sponsors, an interesting mix, but the most of it is really the RIA community that we work with.
Yep. Full and fair disclosure, we utilize you guys at our RIA, and which is, this is why I said, hey, do you want to come be on the podcast? You're personable. You got it. We have similar hair going on, though yours is very lovely and curly. But full and fair disclosure, we work with you. But that great background, and now been running it for 13 years. You've seen the changes that have happened. You've seen the advancement. How the industry actually has moved on. Because I think a great bellwether is what has changed in insurance. What has changed there? I think that's a wonderful lead indicator as to what's happening in the industry. But let me come back to that. And so, Chad, let's ask the question that kind of pulls everything down, but like we rip through is like, Chad, what is everybody getting wrong, and why is it so awful to deal with E&O insurance?
Oh my
What's
goodness.
wrong with it?
What's wrong with it? So here's the irony of it. It would be easier for me to tell you what they get right about insurance. From my perspective, it's a much smaller pile to tell you what's going well in the industry. And the reason is because when you get really niche in any sort of thing, so, advisors, there's advisors that get really niche. They're really good at maybe serving a certain specific client type. Maybe I've seen advisors out there that are working with a specific company and they understand their retirement plan so well, everybody goes to them, right? Mm-hmm. Same thing here in insurance, because we only work with that one client type. We're able to dig so deep that it's the curse of specialization. You start to see all this crazy stuff that goes on. The good news that goes on right is most insurance brokers out there, they're local insurance brokers. They know their local market real good. They're generalists. They can help with just about anything. And they're really personable. They understand, like an advisor, that a relationship is important. But what's interesting is I've learned that yes, absolutely, for financial advisors, that relationship is important, but most see it as transactional when you're buying insurance, because all you know to look at is price, limit, and deductible, make sure it fits. It's going to do basically what I want it to do. And if we're good and we're competitive, let's go.
Okay.
That's the good start. You're going to be able to find a lot of people that can do that very friendly and open and good to work with. Right? Mm-hmm. Then what happens where it kind of goes off the rail, and it's not because insurance brokers are good people. There's a lot of good insurance brokers out there. It's because they don't know, if you ask them what's a 338 versus a 321 ERISA advisor, you're probably going to get deer in the headlights. Mm-hmm. Right? And much less when you're talking about asset types, knowing the difference between a BDC and a mutual fund and an ETF. I mean, and that's the very basics.
Or doing DSTs, if you will.
Or DSTs.
Let's bring out all the acronyms.
Right. We get in there and it's like, now they know insurance really, really well. But when you're a financial advisor in the financial services space, you want to be able to usually talk to somebody pretty quick that knows you. Mm-hmm. And it gets important when we're actually placing the insurance coverage, because all of that can come into factors that get you better terms, and better terms. Part of that's what you're paying. But the most important, you want to know what you're covered for and what you're not. Because,
Well, as just on that, I think for my years in the business, doing a lot of business development, and bringing people into my previous organization and now here, everybody would always ask, "Well, am I allowed to do that? Can I do this?" And they're looking at it, and this is my odd viewpoint. Maybe I'm wrong. Maybe I'm right. Maybe I'm just right. Um, I think the question of can I do that based on policies and procedures, yeah, that's kind of correct. But really, it comes down to, well, but does your firm have coverage for that? Because
Mhm.
it doesn't matter. Like they could, like policies and procedures are should be matching what you actually have coverage for. And I think a lot of people miss out on that too. They say, well, why can't I do that? I should be able to do that. I can do this, this, and this. I go, well, sure, legally with your license you can. However, your firm doesn't have coverage for that.
Right. And so it's a very good point. And the reason, and I look, it's the CCO typically, or it's leadership, C-level leadership that's going to decide what's done and what's not. And the reason it's so important most of the time that the coverage is there is because these claims are not your run-of-the-mill claims. Okay. And most of the claims we're used to is like your home and auto. Okay. And it's interesting when you look at home and auto because auto claims are a lot more frequently. They're going to happen. Last time I looked, about every 7 years. Okay.
Mm-hmm.
But your home claims are and they're fairly small, maybe a few $1,000, right?
Yep.
Your home claims are hopefully you maybe have one home claim in your entire owning of your home, if at all. Maybe,
Mm-hmm.
a fire comes through and it's pretty disastrous and you're going to spend a lot more. So it's frequency versus severity. In the financial services space, especially with E&O, it is something that is not frequent, but it's extremely severe. Meaning when there's a claim, even when you win, it's not unusual to spend $500,000 on that claim if you have a carrier that's really good at defending and aggressive at defending you, which is usually what you want.
Mm-hmm.
So that's why when the principal of a firm comes to me and says, "Hey, are we covered for this or not?" That's smart because they know if they're not covered for it and they go off the reservation, the advisor does, they're gonna have a big potential problem because most people can't afford to shell out several $100,000 to defend themselves because they did the right thing.
Mm-hmm. Yep. You had said something there. If I retrace this back, that I thought was interesting, triggered something. Is the idea of a claim.
Mm-hmm.
Um, and a lot of advisors out there, I think, yeah, nobody wants complaints, nobody wants grievances. We understand that. That's just the way it is. Nobody wants that.
Mm-hmm.
However, that does happen, and everybody's so afraid to even talk about that or talk about dipping in. Would you be able to like give us from your perspective like that I've been through discovery and things like that. I haven't been through a direct arbitration myself. I actually did a mediation years ago. Go look it up in my record. Anybody who has questions, I'll tell you all about it. Like it's years and years and years and years ago. But can you kind of walk us through like that life cycle of complaint to claim to defense to pay? Because I
Yeah.
don't, nobody ever talks about that. And I hope you don't mind talking about that. Nobody ever talks
Yeah.
about it.
Yeah. So I'm happy to talk about it. And here's where it gets goofy, right? Is I say goofy. The reason I say it's goofy is because yes, there's claims and things happening all the time out there. Okay,
Yeah.
so we
You
have
can say goofy.
several hundred.
That's an okay
RIAs.
word to use here. That's an okay
good,
word
good.
to use here.
we get there, and actually with the clients that we have, life is happening for one of them every day, right? And so right now, because I'm the guy at Box Professional, if you're working with us and something comes up that could turn into a claim, I'm the guy that helps. So I'm probably happy to talk about it. What the life cycle actually starts when you have a good support system, the life cycle starts way before there's a complaint. And the reason it's really simple. When you see these movies, and maybe I shouldn't relate it to it. I'm thinking of like Pulp Fiction, and something goes wrong really bad.
Pardon me.
They call in the cleaners, right?
The wolf. I've actually brought that up to people before. You got to bring in the wolf. Harvey Keitel comes in.
Comes in and he's going to help clean the situation up because we don't want anybody to know anything happened here. Don't look here. It's fine.
The Tina situation.
We're
right?
good.
Was that
right.
what it was? The Tina situation.
I think it was Tina. Man, you're taking me back. But yes, the wolf. That's what we do. Okay? And here's what we know is you can call the wolf once the police have shown up, or you can call the wolf as soon as you recognize something went the direction you didn't expect. You're probably going to have better results if you call the wolf before the emergency really takes hold. And the reason I say that is because what we try to do here, and some carriers are really good at helping us with this, is get in there early. And if we do it well, nobody's going to know, because usually the advisor did nothing wrong, but it's a misunderstanding, between the client and the advisor or somebody associated in that relationship. Right. And the reason that breach of fiduciary duty is brought in so much as the definition of a claim, and then there's something underneath it that gives more detail, is because it's hard to prove breach of fiduciary duty. Did you actually do everything that you possibly could to put your client ahead of your own interests? Well, we understand why that's important. But if you stand back and look at it and you say, well, what does that really mean? That can be argued about by attorneys. So attorneys really, it's a valuable thing for them and it's important for us. And the SEC is different than FINRA because the SEC walks around with a very big stick, and they can make your life really difficult. They need that big stick because they're not like FINRA, where FINRA has rules for absolutely everything, which is why a lot of advisors, if you're really good in the BD space, eventually they usually come over to the RIA space because they're like, hey, I know how to do it well. I'm going to do it well. So, and then just, we all get a miscommunication at some point. And so we want to get in there, help with that. And when we do that, usually, more than half of them, we get figured out before it ever goes to a claim.
Yep. Yeah. And to be clear for the regulators that are listening in, we are not saying that it goes away and it doesn't go unreported. We're just saying that we help out. We being bots.
Right.
You've got to help understand this.
Let me give you an example to make it clear, because it's not that anything wrong has happened. Okay. So what's really driving claims, and we track this because this is, I've been watching this from the start, and I can do some backwards testing on it. The claims volume goes way up when the stock market goes way down. You kind of like, well, that's obvious. Now, a good financial planner is helping anticipate, and a good asset manager is anticipating, look, there's things we know, there's known knowns, there's known unknowns. Okay. There's all of these things come into play. So you're actually planning for the unexpected to happen. You're doing your own risk management for those assets. You guys are better than that than I am. Okay. But when the unexpected does happen, it's easy to forget about the conversations that you had with the client, maybe even last quarter, and you said, well, this is the plan and this is what we want to do. And if they forgot about it, or if they die and their beneficiaries think something else, they weren't there, you're managing for the client, not the beneficiaries. So sometimes we have to remind the parties involved of that. So there's all these little misunderstandings and I think regulators would probably appreciate this if we can get in there early and start to explain, well, this is how it works. This is normally how it works. And actually, here's what it looks like to us, and the right things were done or not. And if the right things weren't done, then yes, it's going to go to a claim.
Yeah.
And sometimes appropriately should, because if there were never any claims, this would be a complete waste of money. Nobody should buy this coverage.
Yep. Totally understand that. Can I, because we only get to do this show for about 30 minutes.
Yes. So keep me
Okay.
on track.
So
Sorry.
no,
I get too
you're great. You're
passionate
great.
about
No.
insurance.
That's great. See, because again, we're not nobody's talking about those things. But again, what's really great to hear is that you as an organization, you as the head of your organization, you are directly saying, hey, a chief compliance officer supervision team, when things come up, before you go further, bring it back to us. Let's work with you, as opposed to just go figure it out, then come back to us. And I think that's where perhaps then the advisor roster thinks that no, you just do whatever, and then you just make a claim if needed. Where it's
Right.
like, no, we have to do the more of the front end stuff. It's not like an adjuster's job, right? Well, I was in the accident. Now I'm going to go to the adjuster and they're going to tell me, well, it's actually this amount to fix it. No. We know what's going on. We know what's happening. So before we even get there, let's get everything together and talk about it. And I think we can clear it up together.
That's right. That's right. And here's what we do is when I'm doing it, because I was an adjuster, and it's not that I'm, magic in this awesome, but just because I see so much volume of it, right? We're able to really early on start putting the information together. So if it does need to go to a claim, it's going to be clearer for all the parties that are trying to get this worked out. Because let's be clear, there is a complete system. It's just globally, it's the system that's been built around the financial advisor to protect the clients and keep the industry moving well.
Yep.
Which I'm grateful for, because yes, it does provide me a paycheck, but globally it's good because we're helping to avoid that next stock market crash where people are jumping out of buildings because it went really bad.
Well, we get insurance, if everybody remembers from taking your class and taking your tests, we're insuring against catastrophic failure.
Right.
Okay? That's what it is. We're not, hey, if you want to keep buying insurance and you want to buy every piece, Chad's ready to accept your money. But also let's catastrophic failure, where are we gapping? Which leads me to this question. And Chad, this is something important to me is, let's see if I can assemble this right. Why does it seem like the default coverage for most firms, quote unquote, this is not everybody, but I've seen it a lot, where the default is for errors, it's 25,000. For omissions, it's like 10, and it's a $2.5 million coverage.
Yeah.
Like that's like, seems like everybody kind of gets the same thing. All right, so here's my setup. So it seems like everybody gets the same thing, but in practicality, the issues never necessarily, or a claim never really ever hits that 25,000 mark, or they say, well, that's not an omission, that's a trade. So you don't get the $7,000 deductible. You have to hit the 25, and you didn't hit it, so you're out $24,999 because you didn't hit. So it's just odd to me, like why does that seem to be like that default number? Again, I'm just picking that out of the air.
It's whatever the default number is. And so you'll see I'm a little bit jaded here, and sometimes I get myself in trouble with the insurance industry, because the reality is the house knows on the law of large numbers when those claims are going to come up, how much those claims are going to cost, and they're going to put that line right above where they're going to make the most profitability so that they can maintain their business. Right.
Yeah.
And now that is jaded. Now, the reality of it is we do want good, strong insurance carriers. We don't want them to go bankrupt, and we don't want them to exit the industry, because we need a market. We want several carriers that we can work with, so we're not stuck on one thing, Yeah. But there is a definite, we want to hold in our heads that they hold the cards because they have the most information. Right.
Yep.
And so if we can remember that, and then try and think of it, because insurance, there's always an option to not insure and self-insure, or a deductible. You pay, it's a retention. We call it a retention because that's the risk you're retaining and you're going to take care of first. Okay. So remembering both of those things, that we can use it, and actually it's an advantage to us that this is a severity, not a frequency thing, because there are things that you can do as an organization to reduce your risk. We talk about this a lot, about best practices and stuff like that. But there's also ways you can structure it when you really understand the risk and really understand the client, so you can start to put that risk allocation in an area that makes the most sense. Okay. So what I'm saying, what you mentioned there, Andrew, is typically like a group plan that's covers several hundred IARs, and there's an aggregate limit. And I've seen them where you've got, maybe 1,000, we'll use some round numbers to keep it simple. If you have 1,000 IARs under one plan and the aggregate limit is 10 million with a $25,000 deductible, well, what ends up happening is they're going to price that up to a point where they know there's enough premium there that they're going to be able to take care of the vast majority of it. And it doesn't happen this way, but where you really want to be careful with some of those group plans is if that limit is spread out over those 1,000 advisors and there's 10 million, if they all happened at the same time, you don't have very much per advisor. Okay, so that can freak you out. So thank God the claims don't happen that way. But what it does mean is that the first one to the trough in that year is the one that's going to get the limit, which is not necessarily a good thing if we have a huge market correction.
We're not saying do your limits at the beginning of the year. This is not like best practice of do your RMDs at the beginning of the year. Don't wait till the end of the year. Don't do your claims at all. But, gotcha.
Well, what it is saying is, and when I say a year, as I say, because you can start it whenever. So all of these are on an annual basis, right? So the thing to get smart about, and this is one thing, we're working with Rossby on, is making sure that we're actually aligning the risk more appropriately with the levels that are helping it out. Because when you do that well, the advisor themselves have dedicated limit to them. Okay, so they know nobody can actually touch that limit, and that gives them more control over the expense. And actually, they know if we go over that, they're responsible for that or whatever. And you can actually dial in and get better pricing overall. Okay.
Yeah.
So there's lots of advantages.
Yeah, we're all about advisors controlling capital better at our RIA for sure. And I think that's something, you and I had worked on. We don't necessarily need to go into. Anybody wants to know more about it, call either one of us and you'll get but like really cool stuff. But for sake of time, I actually wanted to bring up something else, and then we'll wrap up. Because again, we don't have unlimited time, even though we could talk about. You, me, and Rich Walker can just talk about insurance and doing forms all day long. And RJ loves all of this, by the way. He's getting such an education. A little birdie told me that those aggregate limits, there are firms, we don't have to say who, there are firms that are collecting E&O premium from their advisors that exceeds the total coverage of the E&O. So they're actually collecting more money in E&O payments than what they actually have in coverage.
Yeah. So
I that blows my mind.
Yeah, and so so here's one thing to know. Okay, it depends on the business structure of it, because in the broker-dealer space, they're much more likely to pay out a claim faster because they're worried about contagion between registered reps. And so the pricing structure on there is completely different than it is in the RIA space. Okay.
Yeah.
But what happens, and you can see this sometimes in the RIA space, sometime in the broker-dealer space, and it's goofy because when I first did that, what I did was I looked at, I don't know, some organization, and they have a thing they send out to all their IARs, and they say, here's what you can buy and here's what it costs. And everybody gets it. Here's the irony of it. It's public information how many IARs they have, and you can do the math, and you're like, this is weird.
Yeah.
It was the first thing I saw that. But part of the thing is, what I do know is that depending on the business, or if they're just large enough and they plan to have X amount of claims, but because of the dollars of it, I'm like, are they really planning to have, because there is, you got to pay the insurance broker, there's overhead costs for the carrier, but even when you back that out, they're planning on paying a significant amount of claims, which to me says maybe there's better loss control they could put in there, because we never want to get to there.
Yeah. So I'm not saying they're evil for doing it. It's more like, well, wait a minute. Like, think about that as you're joining a firm, as you're looking at firms, as you're part of a firm. Maybe that's something interesting to think about, because it's not so much about you paying that. It's your words, the contagion of what are other people in that firm doing that then directly impact you. So people say there's safety in numbers. However, there's odd contagion that happens as well. So I think
that's right.
It's good.
So it's nobody's saying anybody's doing anything wrong. It's just what it is what you see in insurance is you see at a very broad scope, you see the whole forest, and that all of the costs have to be included in that when you back up and look at over a, not even a 1 year, 3, 5, 10 year time frame. They have to stay stable.
Excellent. I love it. Okay, now we're at our mark. This was wonderful. I think we should do this again, and we can have even more fun. Let's talk about the other things that we can insure and how we could do it. Like, we'll talk about cyber the next time.
Oh yeah,
that's my God. I mean, we'll have to rebook for like 5 hours for that one. But so Chad, so you're in Portland, Oregon. You guys just bought a new building.
Yeah.
Right.
Yeah.
Okay. So
that's the old window behind me there.
There you go. So why don't you take us out with your building, why you bought it, how old is it, and what are you going to do with it, and when are we having a party?
Yeah. So it was real fun. So the building was built in 1914. My wife and I kind of like old buildings, and in insurance, it's an old industry. So we like to do that, but we don't like to overspend. So what we see in Portland, the big challenge here is whatever you see on the news isn't exactly accurate. Okay.
Oh, really?
Yeah. Imagine that, right?
I had no idea.
In Portland, commercial space is cheap right now, and that is true. So I said, well, we either buy when it's high or buy when it's low. Buy when it's low, and hopefully it'll get higher. But it's also really great for our team here, because we now have a space where we've been growing a lot in the last 5 years. And so we're kind of all disjointed. Now we're all in one space. And so it's super exciting as we start to bring some of these tools in that we more locally. So you just good team working closely together. We're going to be able to do better for our clients, and that culture. So it's really a kind of a cultural focus, because part of my job is to make sure that we focus on what the client needs, not what we need or want. We might think it's important, but if the client doesn't think it's important, it's let's not worry about it.
Wonderful. Awesome. And when are we doing the open house?
The open house, that's probably going to be in the spring.
Okay, great.
Get a new, let's get some grass in the backyard so we can go out and touch grass and feel the good Northwest freshness. But in a few months we should be having some good parties. So come on out and say hi.
Excellent. All right. Well, I think that's it. That's wonderful. Great overview. Great time here. And RJ, I think we're ready to put this ship into the dock.
Sounds good. I like that. But before you go, Chad, how about some contact information?
Yeah. So one of the best places to reach me is actually LinkedIn. Okay. So Box Pro Insurance. So boxproinsurance.com is our website. When I started, I was the only guy on there. Our team's grown a lot. So you could also email me as chad.ramberg at Box Pro Insurance. But any one of those channels, you'll be able to get to me. And, usually what happens if we haven't talked before, connect and let's get email connected, and then I'll get you my cell phone and we can chat.
Sounds good. Andrew, your contact info?
Everybody always remember how to get a hold of me. Call me, 321-209-0157. It's always a great place. Email me. You can email me at either company email address, aevans@ouroffice.team, if you want to talk about our virtual services, our transition group, a little bit about our new program, Anchor Point, which we have talked about more one day, or over here at the RIA, aevans@rossbyfinancial.com.
Fantastic. Thank you, gentlemen. And most importantly, thank you for listening to the Outstanding Shift podcast. If you have not subscribed to the podcast, please click the subscribe button below. This way, when Andrew and his team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find it. Again, thank you for listening. And for Andrew, I'm RJ Malik, and we look forward to you joining us for the next Outstanding Shift podcast.
Thank you for listening to The Outstanding Shift. Don't forget to hit the follow button to be notified when new episodes become available. Visit our websites at www.ouroffice.team, www.rossbyfinancial.com, or give us a call at 321-209-0111. The information provided in this video is for informational purposes only and does not constitute investment advice or a recommendation to buy or sell any security. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. You should consult a qualified financial professional before making any investment decisions.